Hello, everybody, and thank you for tuning in to the Liberty Report. With me today is co-host Daniel McAdams. Daniel, good to see you.
Happy Monday, sir.
Very good. We got a special program today, and we both know him very well, Paul Martin Foss, who was with us in the Washington office for a good many years, and he helped me so well with the banking committee and the regulations. He knows this stuff very well. And he, of course, just recently attended our conference in Alexandria and did a fantastic job. Paul Martin, welcome to our program today.
Thank you, Dr. Paul. I'm glad to be with you.
Well, good. The subject I wanted to talk about is a subject in general terms you and I have talked about a lot, and that has to do with the Federal Reserve and regulations. And I want to start off with dealing with the Wells Fargo scandal, because that is indeed a scandal. I mean, there's a lot of fraud involved. But I wanted to sort this out, the type of scandal that occurred in comparison to the fraud and the scandal of the Federal Reserve itself. So why don't you give us a little brief update of what's going on with Wells Fargo?
So yeah, the conduct at Wells Fargo was pretty bad. It was over 2 million customer accounts that were created without authorization. The employees were literally taking money out of people's accounts and putting it into these new accounts that were opened without authorization. 5,300 employees ended up getting fired as a result of this. So it was really a kind of fraud on a massive scale that you would have expected, kind of the CEO and the senior vice presidents to have caught and at least been aware of and taken care of a lot sooner. But obviously, like you said, it pales in comparison to what the Federal Reserve System is doing. I mean, the Federal Reserve has created trillions of dollars out of thin air. Its behaviors affect hundreds of millions of account holders, not just 2 million people like at Wells Fargo. So Wells Fargo, as bad as it is, and as deserving as Wells Fargo is of punishment, and certainly its employees who engage in this fraudulent behavior, the Federal Reserve is far more responsible and far more in need of punishment than Wells Fargo is.
Well, the other day, last week, the Senate committee was investigating, and Stumpf, the CEO, was there, and he received some pretty hard questions and all. But, as far as a politician's concerned, he handled it pretty well. And big question is what is going to come of all this? And we find out today, at least I found out today, that if he has to resign or decides to resign, it shouldn't be such a bad deal. He's going to get a $123 million separation fee. So these guys that are involved in this, obviously he had moral responsibility. And I can't believe that he could be a CEO and not, promoting this. This did tremendous things for his company, but he literally has destroyed this country's credibility. But this is part of the system. Where does this come from? I mean, how come it could be so lucrative that somebody could mess up this badly and get $123 million? I think he could live rather comfortably without a sum of money.
Well, and the reason it's so lucrative is because the Fed keeps pumping in easy money, and it pumps it in directly through the Wall Street banks. So it's the fat cats on Wall Street, it's the CEOs, it's the senior executives who are the ones who benefit from all this money. They're basically playing with free money. And, $123 million, the bank probably considers that also just a drop in the bucket. I mean, they've gotten, these banks got total of $700 billion of bailouts back during the bank bailout. Their excess reserves that they've gotten from the Federal Reserve are on the order of trillions. So $123 million, they're probably considering that chump change.
Though, opening up these accounts. It was commission of fraud, but it benefited the bank because they had a lot more customers. It built up their stock prices and allows guys like Stumpf to make a lot more money. And to make more money, he has to have easy credit. And like you said, that credit goes into the banks, so it's related to a system of money. This wouldn't have happened in free market banking. I mean, there's no way they'd do it, and it probably would have been stopped a lot sooner. But what's this story? You and I worked a lot on Dodd-Frank, of course, pointed out all the defects, but this whole thing that the Consumer Protection Agency, it was going to protect the consumer. It doesn't look like it did a very good job.
Right. I don't think they caught this thing. They were kind of, I think they got some credit from Elizabeth Warren, but it was completely unwarranted. They kind of just, once this thing kind of blew up, they kind of piggybacked on it. Was really, the first complaints were going into, the Office of the Comptroller of the Currency, who was the main regulator. But even they, very early when this stuff was happening, all they were doing was sending letters and saying, oh, you need to stop this. They weren't actually doing anything to stop this program, and the program ended up getting way, way out of control, and the regulators just completely were asleep at the switch. They allowed this thing to get to the point where 2 million account holders were affected. Had they actually done what they're supposed to do, we wouldn't be hearing about this today. This would have been stopped 3 or 4 months ago, but it just goes to show that the regulators are not really they're not effective. They're not actually out there to stop any of this bad behavior. They're basically just out there to kind of increase their own power and their own budgets. And what's going to happen now is they've been shown to have failed and not to have stopped this program. So what's the result? They're going to get more staff. They're going to get more budgets. Congress is going to pass more regulations, and you're just going to get this. The OCC and the CFPB and all these regulators are going to get more power and more money and more authority. And there's going to be another scandal, coming down the pike probably in a couple of years. They're not going to be able to stop that either. But they're going to, the solution to every crisis in Washington is, if the regulators fail, give them more money, give them more staff, give them more power.
Daniel.
Sounds like never let a good crisis go to waste.
There you go.
Yes, exactly.
But on the same point that Dr. Paul was making, we thought that Dodd-Frank was supposed to protect consumer privacy. But, of course, the government as a regulator of privacy, they're the biggest violators of our privacy.
So why?
So what's the point?
Yeah. Yeah, it's all just one big mess. And it still remains to be seen. Now that this, of course, is becoming a big scandal and is out in the public eye, all the regulators now want to jump. SEC, I saw, is going to be jumping on this because of, this obviously, because it was involved with sales targets, was something that was used to kind of game the stock price. So they're going to go and see whether there were false, declarations, et cetera, made during the SEC filings. So that they're all fighting for scraps now.
All right.
Trying to get a piece of the pie, trying to get their name in the public eye, trying to make a name for themselves and boost their own regulatory careers. The people, the customers who were affected, they're not going to get anything out of this. I mean, even if they file a class action lawsuit and win, their lawyers are going to get the lion's share of the money. It's the account holders who suffer all the time, while the Wall Street CEOs escape prosecution and the regulators just get more money and more authority.
They talk about more regulations. The regulations are always placed on some type of market activity, and they blame the market. So the market is always responsible for the recessions and depressions, never the Fed. But they never talk about regulating the Fed. If we had to have regulations to solve this problem, why couldn't we suggest to them, which they would not accept, why don't we regulate the Fed and tell them that they're not allowed to set interest rates and they're not allowed to create credit out of thin air? I don't think they would like that too well, because that would be invading this principle that they're independent and they don't need a regulation. Of course, I always argue that independence was equivalent to privacy and secrecy, so that they can do whatever they want.
Right. And Congress has has such a cozy relationship with the Fed and with other regulators. I mean, you remember every time there was a hearing up on the Hill, the first thing they do whenever there's a government witness is they go overboard saying, "Oh, thank you for your service and to this country and to the American people," yada yada yada. They bend over backwards. They don't keep the Fed or the OCC or the CFPB or any of the regulators on a short leash. They don't exercise any sort of oversight. They don't call them to task when they fail. It's very striking the way that they rightfully, tore into the Wells Fargo CEO, but you would never, ever see them tear into Janet Yellen or Ben Bernanke in the same manner.
Right.
Yeah, you mentioned regulating the Fed and looking into the Fed. And by the way, Paul Martin, I want to thank you very much for speaking at our conference earlier this month. It was, Dr. Paul, I'm sure you agree, it was such a great talk. How the Fed facilitates war. And it's not exactly what we're talking about today, but it really is so critical to what we do. But I'm going to ask you to speculate a little bit, if you don't mind. And as you know, I focus a little bit more on foreign policy, but also where the Fed and foreign policy sort of intermesh. But talking about regulating the Fed, what do you think a Fed audit would expose with regard to the Fed's activities in foreign central banks and even as far as foreign policy of foreign governments?
I think it would expose everything. We literally don't know what the Fed is doing, except with, whenever they enter into a swap agreement, we get supposedly the text of those swap agreements with the foreign central banks. But we really, aside from that, we don't know to what extent the Fed has basically become kind of the world's central bank, the world's lender of last resort. I was talking to somebody a few weeks ago. I forget who it was, but basically the IMF has been supplanted by the Federal Reserve. What the IMF was supposed to do in terms of international monetary cooperation, the Fed is now doing, but through its swap lines with central banks, its dollar liquidity lines, and all this stuff. I mean, we don't know about any of the Fed's meetings with foreign central banks. We don't know how often Janet Yellen is going to Switzerland to talk to the Bank for International Settlements. We don't know what kind of liaison agreements there are between the Bank of England, the European Central Bank, and the Federal Reserve. We don't know, the extent to which the Fed's swap lines are stimulating purchases of Treasury securities abroad, or to what extent the Fed is helping, other central banks to purchase their own government securities. We literally are completely in the dark when it comes to the Fed and foreign activity, and that is probably the most effective thing that a Federal Reserve audit would bring to light, where we would finally, know exactly who they're meeting with, who they're talking to, what they're talking about, because right now we don't know a thing.
The system that we have today is very encouraging. We talk a lot about malinvestment and excessive debt, which they get involved with when they have easy credit and they get the wrong information with interest rates. But then there's the other thing that compounds this. If they did that, but they were up against the wall of something in the market like a failure, they might be a little more cautious, but they don't even have to anticipate that because of the moral hazard of the insurance system, the FDIC. And also, most people know, no matter how much they talked about not changing this too big to fail business, we know that it's too big to fail. They are going to get bailouts, and they work on these assumptions. I don't think they're going to bail out Wells Fargo. I think they're going to keep that thing going for a while. So it's this bailout. So I think it's this moral hazard that you cannot handle under the circumstances that we have today.
Right, and every time you start increasing more regulations in the banking sector too in response to all these crises, all you're doing is raising barriers to entry that makes it more difficult for the smaller banks, the mid-sized banks to compete, and you're making the big banks bigger, so you're actually compounding the problem and making it worse. The reason you have these Wells Fargos and Citibank and Bank of America and these banks that are too big to fail is precisely because you keep adding more regulations on top of what we already have, and make it so that only the biggest banks can compete and only the biggest banks can survive, and it ends up making the problem worse and worse.
When they're working on a regulatory bill, the lobbyists for the banks, they're everywhere to be seen because they do come in, and people who argue more regulations, they won't admit that the people who are going to be regulated have a lot to say about the regulations. We could go all the way back to 1913 and say who is creating this system to protect bank failures and protect the value of it all. It was the big banks that did this. So they're always in a position where they're protected. So these regulations, I see this in medicine too. The FDA and others with the doctors, they get to write these bills. The drug companies are very much involved. So I think the principle is completely wrong, and they sort of feed into a system the people who are honest and earnest, and they think, well, it's a terrible thing, and we have to try to protect the consumer. They actually make things much worse. Right,
and it's like you said, the lobbyists. I mean, they are there talking to the congressional staffers and getting they're drafting their own pieces of legislation and giving to the staffers and saying, here, you want something? This is what would be a good bill. It's completely self-serving. They're the ones who are talking with the regulators. They have meetings with the regulators all the time. Their opinions are the ones that have a lot more weight. I mean, there's nobody from, say, Joe taxpayer who's going in and talking to the Federal Reserve or the OCC or SEC or any of the regulators and getting their opinions through. It's always the big money and the power and the influence of the big banks.
What is your opinion about the effort now that we're hearing about on restoring GlassSteagall to try to prevent these problems. And you and I had sorted this out once before, but have you noticed that it looks like there's some pressure on, even from some free market people thinking, well, we better just prohibit the banks from doing certain activities?
Yeah, it's this type of nostalgia for, I guess, the good old days, what people perceive to be the good old days of the 1930s, which were anything but, of course, where banks were prohibited from engaging in both, consumer banking and investment banking because there was the, thought that they would be kind of at cross purposes. There's really nothing wrong with banks getting involved in both of those businesses as long as the taxpayers don't subsidize investment banking activities through federal deposit insurance. That was the problem with the problem with getting rid of GlassSteagall was that it opened up those activities to federal, being backstopped by federal deposit insurance, kind of indirectly.
Yeah.
So if people want to not subsidize those, great, but the solution is get rid of the deposit insurance, get rid of that implicit or explicit sometimes government backing. It's not to ban banks from getting involved in certain activities.
Yeah, that was one of those votes where I voted with a group that liked the idea of regulating the banks, but I was doing it for what you said, that I wasn't in favor of turning more risk that the Fed and the government has created, and the taxpayer has to bail them out. So it's a messy system. They don't come from a basic principle of free markets and the prohibition against fraud. They just encourage it. We have a few more minutes, but I wanted to get your assessment on where the next bubble is and when that's likely to happen, because this is essentially what we've gone through. I know not only in your lifetime, but my lifetime, it's been up and down ever since we've had the Fed. And they create the bubbles and the recessions, and it keeps getting worse. And it seems like we have a pretty big bubble going right now. Is there one particular area that you think is more bubbled up than anything else?
That's a tough question. There's so many bubbles. I see mini bubbles all over the place. I see, fine wines, whiskey, exotic cars, art. You see a whole bunch of really strong price increases there that are much greater than what you would expect in a normal market. So there's obviously some money flowing there. Stocks and bonds obviously are in a bubble of some sort. I would think that probably the first indicator that a bubble is going to start bursting is when stock and bond stocks and bonds start to fall. Real estate, a little bit of residential real estate and commercial real estate too. We had so many foreclosures back during the last financial crisis, and a lot of those. A lot of properties, really the only underlying strength in the real estate market is through institutional investors who were, hedge funds, private equity, et cetera, who were buying up these properties and creating property management companies and owning tens of thousands of what end up being rental houses. Mm-hmm. I think that might be another, potential bubble area that might burst.
Paul Martin, I think your answer is perfect, because this has been going on a long time, and we're ending the stage, of how many times can they inflate and have deficit spending and get the economy going again. And you described a lot of bubbles out there, and that would be probably a pretty good sign that things are grossly out of whack and that a correction could start almost any place. But this, I think we live in very, very dangerous times.
Oh, and it could start at any time. I'm very much concerned that within the next year or two, we're going to face a financial crisis that makes 2008 look like a cakewalk. The next crisis, because this bubble has been blown so large, the Fed is really, there's nothing the Fed, in the face of another financial crisis, there's really nothing the Fed can do. It's already, purchased $3-4 trillion worth of securities. There's no way, there just are not enough assets for the Fed to continue quantitative easing in the event of another financial crisis to the same extent that they are doing right now. So they are basically they've kind of hit the wall in terms of their response. The next financial crisis, they're not going to be able to even attempt to try to bail somebody out. So that we're just going to have to suffer the effects, and it's going to be the effects of this huge bubble that they've blown for the past 8 years. And I think it's going to be very painful and, could go on for a very long time.
Right, and I certainly share those concerns. Paul Martin, I want to thank you very much for being with us today, and we'll stay in touch.
All right. Thank you, Dr. Paul. It was good to talk to you.
And I want to thank the audience for being with us today on this very important issue. Even though we talked about Wells Fargo, it is an example, once again, of how governments, regulations, and monetary policy messes up. And it just calls attention to the organization that has been responsible for so many of our problems, and that is the Federal Reserve. If you go all the way back to 1913, created the inflation for the war and depression in 21, and then inflation of the 20s, the depression of the 30s, on. And every time there's more and more regulations trying to regulate away their mistakes. It's impossible. We need regulations to regulate the Federal Reserve into oblivion, because it's an immoral system, and you can't get morality in the marketplace when you have an immoral system of money. It wasn't intended. The founders hated it. They wanted only gold and silver to be legal tender, not fiat money, not paper money. And yet here we are today. Not only are we engulfed in it, but the world is engulfed in a fiat monetary system, which is very, very huge and very, very dangerous, but there will be a correction. I want to thank everybody for tuning in today to the Liberty Report. Please come back soon.